In this video, we're going to learn how to close the books. A company will close its books at the end of an accounting period in order to prepare financial reports and to prepare the financial records for the next accounting period. This is accomplished through the closing process. In this process, all temporary accounts are given a zero balance or are closed out. The temporary accounts that are closed are revenues, expenses, and the drawing account. The permanent account balances remain the same and are simply carried forward into the next accounting period. Permanent accounts are those on the balance sheet. Some examples are cash, supplies, capital, accounts payable, and accounts receivable. Any asset, liability, or capital account is a permanent account and will not be closed. So let's take a look at the closing process. There are 4 steps in that process, and I've created a mnemonic that maybe will help you to remember those 4 steps in order. Okay, the mnemonic is REND, R-E-N-D. So the R stands for revenues. So the first step is to close the balance of all revenue accounts to the income summary. The second step is E, which stands for expenses. Close the balance of the expense accounts to income summary. The third step is N. So N is for net income, and that is what remains in the income summary after we close the revenue and expense accounts to the income summary account. So in this step, we're closing the amount in the income summary, which should be net income, to the owner's capital. And then the fourth letter is D for drawing. We're going to close the balance of the owner's drawing account directly to the capital account. So let's look at this process in C now and see how that works. Okay, we're working on assignment 10, which is exercise 6.04, and we're given a partial worksheet here which shows the income statement and the balance sheet, and we're going to use that to enter our closing entries over into the journal, and then we're going to post those to the general ledger, and that way you'll be able to see exactly what happens to these temporary accounts when we close them out. Okay, so if you're given a worksheet, the closing process is pretty easy because everything that you need to close should be in the income statement column with the exception of drawing. We'll go pick that up last, but here is the revenue R, our expenses, the E's, net income down here for the N, and then D for the drawing. Okay, so let's get started with our first step is R, closing the revenue account. Our revenue is advising fees. Advising fees has a credit. If we want to make that 0, then we're going to debit this account. So if we debit advising fees for $41.40, then it's going to bring the advising fees account to 0, and then those revenues will be closed with a credit to income summary. That will be our offset account in the first 2 entries in the closing process. The second step is E, which is for expenses. We close all the expenses to income summary. So our expenses are listed here on our worksheet, and notice that the expenses have debit balances. So to close an account that has a debit balance, you should credit it for the amount of its balance. So we are going to credit all of our expense accounts and debit income summary for the total. So I'm going to go ahead and enter the income summary account, and now I'll start closing out the expenses. So wages expense will be credited for $700. Advertising will be closed and credited for $90. Rent expense we're going to credit for $500. Supplies expense gets closed for $150. Phone expense gets closed for $67. Electricity expense gets closed for $48. Insurance expense gets closed for $89. Gas and oil will be closed for $53. Depreciation expense gets a credit of $200. And miscellaneous expense will be credited for $23. Okay, so you may or may not have the total here. The worksheet has provided the total for the expenses for us that will go into income summary, but if you don't have the total, just simply add up all your credits and put it in the income summary debit. So according to our worksheet, the total expenses are $19.20. Okay, so we have the first R entry, the second E entry. Now we need the N, which, remember, the N stands for net income. So this is a very often missed step because students will try to close the capital account instead of closing the net income from the income summary to the capital. So there are a couple of ways you can figure out your net income. You can take 4140 minus 1920 and you'll have your amount for the third entry, or you can just go over, if you have a worksheet that you're working from, and pick up the net income from the worksheet. So what we're going to do is close out income summary directly to the capital account. So the amount, remember though, is the net income amount. You are not closing capital. Capital is permanent. We never want to close the capital account. What we're doing is increasing the capital by the amount of the net income. This entry physically takes the net income and puts it in the capital account. Remember our statement of owner's equity, when we calculate our new capital, we add the net income. Well, this will physically add that net income to capital, so your capital account will be updated. Remember, it's not closed, it's just updated. And income summary now will be closed because we had a credit of $41.40, then a debit of $19.20. So after these two entries, we had a credit balance and income summary of $22.20. So if we debit it in this entry, it goes away. So the most important thing to remember is to make sure you use the net income figure for your third entry. Okay, and now the last entry is D. Close the drawing account. So drawing is up here with a debit balance of $900. So if we have a debit balance of $900, the way to close that would be to credit drawing for $900 and then debit capital. Okay, so remember, drawing reduces capital. So with this debit, we are bringing the capital balance down by $900. Okay, so once we've got everything journalized, then we can post these journal entries over to the general ledger. Okay, and instead of a general ledger, it looks like here we have got T accounts, but those will work. All right, first we're going to take advising fees and debit those for $41.40. So we'll find that account. Okay, and we'll close it out with a debit of $41.40. And so we have a debit of $41.40 and a credit. So now this account is 0. So we want to come up and put our posting reference in our journal. Income summary gets a credit of $41.40. So we are going to enter that credit there, and then the posting reference of $313. Now back to income summary, we have a debit of $19.20. Okay, so we'll enter the debit, and now after this entry, if we balanced out this account, we would have a credit balance of $22.20. Okay, when we need to put that posting reference in. Okay, now we're going to start closing out our expenses. So wages expense has a credit of $700. So we'll credit that account for $700, and that goes to 0. All right, advertising expense gets a credit of $90. Okay, it already has a debit balance, so that takes that account to 0. Rent expense will get a credit of $500. That's $521. Supplies expense is going to get a credit of $150. Oops. That's account number 524. Phone expense gets a credit of $67, and that's account number 525 for the posting reference. Electricity gets a credit of $48. Insurance gets a credit of $89. Gas and oil will get a credit of $53. Depreciation will get a credit of $200. And miscellaneous will get a credit of $23. Okay, so second entry has been posted, so that means that all expense accounts are now 0. All right, third entry, we're going to debit income summary for $22.20. Okay, so we're going to enter the $22.20. So now after this third entry, income summary has a 0 balance. It's a very temporary account. We only use it really for the closing process. Just open it up for just a very small amount of time, and then we close it right back out. Okay, and now we're about to update capital with a credit of $22.20. Okay. Okay, and notice that capital did not close. We just increased it by the net income. Okay, the last entry where we closed drawing to capital. Capital gets a debit. That means it gets decreased for $900. Okay, now let's balance out that capital account and see what we have. Okay, so our final balance in our capital account is $54.20. So this is the amount that's going to show on the balance sheet and on our statement of owner's equity. This is the updated capital for the accounting period. And then we're going to close out our drawing account with $900. Okay, so now after we've posted our closing entries, all of the permanent accounts up here will just flow over to the next accounting year, because we're not going to zero out our cash or our accounts receivable and start a new year. They just flow to the next year. And then when we get down to our revenues, expenses, and drawing, the temporary accounts, they will all be zero. So we'll start a brand new year counting the revenues, expenses, and drawing for the next year. Now that we've closed out our accounts, the only step left in the accounting cycle would be to prepare the post-closing trial balance to ensure that our accounting equation is in balance before we go into the next fiscal year.